On today's Hot Sheet, I'm discussing Fannie Mae's Economic Developments Report and September house price indices from FHFA and S&P Case-Shiller. Today is Tuesday, November 26, 2024. I am Byron Lazine, and the Hot Sheet starts now. Welcome back. Welcome back, I guess, to me. I'm glad to be back, and thank you, Jason, for being excited about my return. I was hoping that there would be at least some level of excitement. We weren't going to be just saying, "Okay, let's go with Tom Toole and Jeremy Knight and Trey and these guys." I was hoping that there would be some desire to have me back. Anyways, all kidding aside, I am glad to be back here on the Hot Sheet. We have a shortened week, obviously, with no hot sheet on Thursday. Hope everybody's gearing up for a great Thanksgiving. We do have the Hot Sheet today, and I will be back with you all tomorrow. Hot Sheet, of course, is brought to you and powered by Zoodealio. It's where agents are getting more listings and creating a competitive edge against any iBuyers. This is a platform that is included now inside of BAMX. All BAMX members get free access, free platform to Zoodealio. Use code HOT to get into BAMX today. Jeremy Knight voting for Jeremy. That is a 1-of-1 vote, I believe. As we kick it off here, let's get in. We've got a bunch of stuff going on here. We've got Fannie Mae's economic developments, which actually sent some ripples through the economy and how people are looking at the 30-year fixed going forward. I saw that here on my vacation over the past week. Also, we have a report from Case-Shiller, the gold standard on prices, and the FHFA report, both rearview mirror reports on what the market performed, the September house price indices, the performance of that as we obviously get now into December. So those are super rearview mirror lagging data. We know that. We cover that every single month that they are released, but important to look back on what where those numbers actually settled out at. All right, first, let's get into Fannie Mae. Now, Fannie Mae is predicting in their economic development report, November 2024, they are predicting weaker home sales. Okay. So we've been looking forward to maybe, just maybe, a year in 2025 where existing home sales come off of the all-time or near all-time lows in considering, population and all of that. Wall Street Journal headline as recently as a few weeks ago that we covered showed us that the existing home sale data is on track to have its worst year since 1995. That's where existing home sales are trending this year. And so, we wanted a considerable bump. We expect there to be a bump in 2025. Now, Fannie Mae, though, is projecting that we should tamper those expectations. And the big reason for that is interest rates. There is a consensus now from Fannie Mae and from others that the 30-year fixed rate may be higher for longer. We talked about that at the beginning of this year, that the 30-year fixed might not be exactly where we know the needle starts to really move. Those low sixes, high fives, that may not happen really in 2025. And that's not only Fannie Mae, but others are projecting this. Okay. So the current forecast, as we look at the 30-year fixed since the election, okay, many are tying this to the President-elect Trump victory, is that the current 30-year fixed forecast is higher than the prior forecast. Prior forecast had under 6% on the 30-year fixed going into really that spring 25 selling season, which we know would have turned over a lot of pent-up demand, would have turned over some of those locked-in sellers. Now, looking at the current forecast from Fannie Mae, current forecast is telling us that we'll be in the sixes all of 2025 and into 2026. not seeing a 5 handle for really the next couple of years, according to these Fannie Mae projections, considerably different than the prior forecast. A pretty sizable adjustment on how Fannie Mae was feeling about the 30-year fixed before election and how they're feeling about it now. This is coming off of obviously Jerome Powell commentary that they're not going to rush to continue to make these cuts. Powell is, I think, maybe in a wait and see. How's the economy going to react to some of the new administration's policies and the agenda that the new administration? If you look yesterday, there's already some headlines being made about the tariffs that are going to be enacted on day one. Tariffs on Canada, Mexico, China. These are the biggest trading partners that America has. This is where America imports a lot of goods, right? Is particularly Mexico and China. And so how are these tariffs going to impact the economy? And, what type of, how our investors are going to feel about these tariffs, and what type of ripple effect will they have, obviously remains to be seen. And maybe that's why Powell, maybe that's why the Fed is saying, hey, we're just going to wait and see. We're not going to rush to anything. Mandate, again, is to get inflation down to 2% and to maximize employment during that time. If at any time we see employment take a hit, then we know the 30-year fixed forecasts like this one that we're looking at here with Fannie Mae are going to change dramatically. The 10-year would change dramatically if we see employment weaken. Okay, we're not seeing signs of that right now, but if that were to be the case, that would be a driver on getting these rates down. Existing home sales take a hit now in this current forecast with Fannie Mae. Certainly a hit as opposed to the prior forecast. All right, prior forecast had us close to 4.5 million by the beginning of 2025. We don't see that number until we get closer to 2026 on existing home sales on the current forecast with Fannie Mae. New home sales now do not take a hit. In fact, new single family home sales go up. Think about this. Interest rate, an interest rate environment where they're higher favors the builder, believe it or not, versus the existing home sale owner. The existing home sale seller probably gets locked up into a lower rate, while you see builders being able to negotiate on rates at a much more significant level, which creates more buyer interest and more sales on those new homes. Jason says, compared to others, wouldn't you agree Fannie Mae is very conservative in forecasts? Now, Fannie Mae is particularly, I would say, conservative over the years that we've seen. They're going to, as these numbers come out, they are going to be a little bit more conservative at times than others, but not as conservative as MBA, Goldman Sachs, or Housing Wire is on existing home sales. Okay. So Fannie Mae coming in at 4.5 million by the end of the year is still higher than Mortgage Banker Association, Goldman Sachs, and Housing Wire. Goldman Sachs and Housing Wire at an identical 4.2 million. Would be an increase from where we've been at for the better part of this year, but still not a significant bump. Talking about 4.2 million, talking about maybe 200,000. The 4.5 million would feel like a real bump. So if Fannie Mae's right on existing home sales, we're probably closer to feeling that across the country. NAR at 4.9 million, certainly the most bullish on existing home sales. And we'll see where that ends up. NAR, Lawrence Yun coming out with the most bullish of all of the forecasts here. Now Fannie Mae dropped its expectations for home sale growth in 2025 from 11% to 4%. So this 4.2 million is a 4% bump as opposed to where they were, which was an 11% bump. And you've seen this 10 or 11% number floated around there by others, like a 10 or 11% bump on existing home sales would be significant. There's two sides to every deal. It's the way, agents obviously are looking at that. 10 or 11% would be significant, but now Fannie Mae, along with others, MBA, Mortgage Banker Association, kind of pouring some water on that. And that's reflective here in this Fannie Mae outlook. Single family housing starts on the current forecast, taking an initial bump. If rates are going to be higher and existing home sales are not going to be the competition for home builders that we expected, if it's not going to be at a 10 or 11% bump and it's going to be closer to a 4, then single builders are going to go and start more homes on single family because they'll have the advantage. So Fannie Mae's projection mirrors that. Multifamily housing starts, the prior forecast being much greater than the current forecast. Multifamily housing starts are going to be much more impacted by this higher rate prediction that Fannie Mae is now projecting. Single family mortgage originations, okay, on purchase and refinance, both are taking in 2025 a slight uptick per quarter, except for really quarter one versus what 2024, particularly quarter two, quarter three, and quarter four, all having an uptick on purchase application, single family originations, rather, not applications, according to Fannie Mae. And really in 2026, you see those numbers move up considerably. If we look at the economic forecast table now that Fannie Mae has out for November, you see GDP coming in at 2.2, 1.9, 2.1, and 2.2 across the 4 quarters in 2025. Those numbers would be less than what we saw as accumulation in 2024, coming in at 2.1 for the year on GDP growth in 2025 on the projection. 2024 GDP at 2.4, according to Fannie Mae. So GDP growing slower in both 25 and 26, according to Fannie Mae, versus 2024. And 2023 came in at a 3.2. Okay, remember, so a lot of the GDP in 23 and 24 has been driven by government hiring. There is a belief, or part of the agenda here with the new administration, that there won't be that level of government hiring. In fact, there will be a government reduction when it comes to hiring. So GDP potentially taking a hit, and that being one of the reasons why. Of course, I think this administration would argue that some of the other things they're going to do are going to boost growth, and all of that remains to be seen. Unemployment from Fannie Mae's perspective, coming in pretty steady at 4.3 and 4.4 across the board, and the 10-year staying at 4.3 for the entirety of 2025. 4.3 on the 10-year. That's exactly where we are sitting right now on this live hot sheet. Okay, we are at 4.30 to the dot on the 10-year right now. Here's what the last 5 days look like. We've come down from 4.4 range, 4.425, to this 4.3. And 4.3 is where Fannie Mae has the projection coming in for the entire year of 2025. That would be, there's no, not having volatility or not having a drop closer to 4 seems like it would be a surprise. We've gotten there before. We'd love to get below 4 again. But that's where Fannie Mae has the projections coming in. Going back to the housing forecast table now. By the way, the forecast table is available for you to grab inside of BAMX. We've carved out the important relevant charts for you so that the relevant information that you need to speak to your customers, to your clients, to your database is available for you to grab and go inside of BAMX. We've sifted through the hundreds of pages on this report so that we can just boil it down to what you need, basically sifting through any of the nonsense so you can just grab and go on with your business. get into BAMX using code HOT to get today's lowest price. Housing starts, again, showing a slight bump up from, I guess pretty steady with 2024, a slight decrease from where we were in quarter one. This is on a year-over-year annualized basis. Total housing starts coming in at 1.3 million, really across each quarter, annualized again for the year. Single family reaching 1 million in quarter four, and multifamily in the 300,000 range. Total home sales, 2025 quarters look like this: 4.6, 4.8, 5 million, and 5.1. Remember, that's total, that's not existing. If we go down to existing, quarter one annualized coming in at 3.9 million, dangerously close to what we consider the worst of the worst, going back to 1995 on existing home sales. So quarter one, according to Fannie Mae, not getting better on existing. We just cracked 4 million in quarter two at this 4,085,000 mark here on existing home sales, 4.255 quarter three, and it takes till quarter four, and we don't even get to 4.5 million. We get to 4.429 on existing home sales. It's annualized year over year. So each quarter Fannie Mae showing gets a little bit better as we move through 2025 on existing home sales, but still not really to the level, certainly that the most bullish case is being made by NAR or by the hopes of what I think many agents across the country would like to see. Now, going back to the 30-year fix, if we just look at this by quarter, it's 6.5, it's 6.4, it's 6.3, it's 6.3. Throughout the four quarters of 2025 would all be lower than where the averages came in 2024 at 6.7, 7, 6.5, and 6.6 now for quarter four as a projection to close out the final quarter here from Fannie Mae. You go to 2026, you see projections of 6.2, 6.1, 6.1, and 6.1 on the 30-year fix. So Fannie Mae in the real bear camp for the 30-year fixed, as we do a look forward 2-year basis, 24 months of a 6 handle on the 30-year fixed. Let's all root for Fannie Mae to be wrong in that projection, but it's an important projection for us to consider. It's an analysis that I think should be shared with some of your clientele. If you've got buyers waiting for this, this 4 handle that they remember from 2021 and early 2022, it could be waiting a very long time. If you're making decisions based on an interest rate that we may never see again in the foreseeable future, or we may never see again outside of some type of great financial crisis or 100-year pandemic like we saw this last time, right? It's going to be really hard to get an interest rate in anywhere close to that respect. And sometimes people have this falsehood, this false belief that it will get there, when in reality they should be taking advantage of the opportunities that are in front of them. It's important to educate your clients on what's going on. Right now, Mortgage Banker Association, just switching off of Fannie Mae, if you look at Mortgage Banker Association, they're right there with Fannie Mae on their 30-year fixed mortgage rate projection. They've got us starting quarter one at 6.6. That would be lower than where we ended the day yesterday in the 6.9s. Quarter two coming in at 6.5, and then quarter 3 and 4 at 6.4. So MBA, Mortgage Banker Association, basically has a 6.5 for the entirety of the year. That'd still be about a half a point below where we've been at here in the last 30 days. And when we get into 2026, Mortgage Banker Association has this at 6.3 flat. So now you're starting to see, kind of a pile up from multiple projections that this 30-year fix isn't going to be a 5-handle year in 2025. Remember all the 5 talk in 2024? Well, if you were with me on the hot sheet in January, I said, no, do not pay attention to that. Don't start spreading that dirty little rumor to your clients. You'll look like, a bozo come halfway through the year. If you start telling them you're going to be in the 5s all year in 2024, obviously that didn't happen. We're closer to 7 most of the year than we were 5. And so now we got to take these projections seriously. We have to acknowledge them. We have to share, we want to share optimism as much as we possibly can with buyers and sellers and people who are interested in the housing market, but we have to also share the reality and uncover the opportunities. It's important for us as real estate professionals to get this information out to the people who need it to make the educated decisions, closing that knowledge gap with all of our customers and clients and folks who are, thinking about making a move. All right, let's take a look at what moves were made in home price appreciation according to the gold standard. S&P CoreLogic Case-Shiller Index is considered by most the gold standard. This is lagging data, of course, as we're almost now into December. As we get through this weekend, we'll be there. And we're looking all the way back at September. Okay, so S&P CoreLogic Case-Shiller records a 3.9% annual gain in September of 2024. This is the leading measure for U.S. home prices. Okay, that 3.9% gain, which is a healthy gain historically, by the way, when you look at that year over year, is still, and this is a trend, a slight deceleration from the previous annual gains throughout 2024, meaning month by month as we go through 2024, this number of year-over-year home price appreciation has gotten smaller and smaller. We expected that to be the case as you're later in the season. In the winter months, this number gets smaller when you look at November, a couple months forward. When you look at December, always does. Okay, so 3.9% now in September. Expect that number to continue to move down. All right. The 3.9% in September is down from a 4.3% in the previous month. Okay. So when we looked at August, we were coming in at 4.3. So this number continues to move down as expected. Didn't expect really anything different than that. If we take a look at the 10 city, the 20 city and the 10 city, yes, composites, we can get the whole picture here. All right. So U.S. National, again, moving down 0.1% on a September-August change. And the 20 city moved down more at a 0.3% negative and a 0.4% for the 10 city. Okay. Atlanta was down 0.2% when you look from August to September. Boston down 0.6% on home price appreciation. Charlotte and Cleveland being two that moved up. Charlotte barely, Cleveland by over 0.5%. Cleveland may be the biggest mover on the list, and in fact, they are the biggest mover on the list in the upward direction. Detroit and Vegas moving up a tick. New York a tick. Vegas by Phoenix rather by 0.3%. Washington staying flat. Everybody else on the list moved down. San Diego and San Francisco, some of the biggest movers down, along with Los Angeles. So the major California cities on the list all moving down the most, almost a full percent. Looking again at the West, you've got Denver at 0.8% down. Okay, year over year, some of the biggest movers remain. New York at 7.5% up. Vegas at 6.7, Detroit at 5.3, Chicago 6.9. When you look at who are the big winners year over year, you see nobody out of the 20 city composite, no city rather, in the negatives. Denver getting dangerously close. Probably expect them to be there if they experience another month like they had from August to September. As we look at this, next month. The year-over-year change in Denver is only a 0.2% appreciation on home prices. Denver now trending towards the negatives. By the time we get to the end of the year, how many join the list? But remember, 0.2%, let's be serious here, is not a huge move down. You see some, I keep seeing Logan Motoshami from HW yelling at some of these people on X who have no idea what they're even talking about. Home price projections on Twitter or on X. People say, "Oh, well, let's see a 40% drop next year, 30%." It's just never even happened ever in a single year. And certainly, just because a home price moves down 0.2% or up 0.2% year over year does not mean the world is coming to an end. It actually means there's stability in the market, and some of these prices are really holding firm while more inventory is being introduced into those markets. Here's the look going back to August and July. You do see, month over month as we get into these later months, and expect this to continue. There we go. Maybe I'm back. All right. Not sure what happened there, but my screen went black. Hopefully you guys can hear me. Let me know in the chat, somebody, if you can
You're
hear
coming
me.
through great, Byron.
Thank you, Bobby. Appreciate that. Thank you for bailing me out there. All right. So there's your Case-Shiller report. Again, we've pulled out the relevant data back now. Thank you, Justin. You can pull out the relevant data that you need, grab and go. Of course, inside of BAMX, join thousands of agents of change that are utilizing BAMX every single day in their business. Home price appreciation now going over to FHFA. Home price appreciation according to FHFA for previous 4 quarters. Now looking at quarter 3, 4.3% for quarter 3. Again, we've moved down to a 3.9 according to Case-Shiller. Looking at the change by states here on a house price change rather by state. If you look at some of the big ones here year over year, Connecticut at 8.1, Mass, that New York in the 8s and 7s, Rhode Island. So that Northeast, Delaware, that Northeast sector seeing the biggest gains. Florida only now at 1%, according to FHFA. California at 2.8, Texas at 1.4. The West, these numbers are moving down, while the Northeast continues to see the biggest gains, and the Midwest, the West and the Southeast moving down the fastest on home price appreciation, according to FHFA. This still remains maybe one of the greatest charts in history when we took at house price. This is monthly house price index, okay? Monthly annualized rate year over year from January 91 to present. Those same buyers who are waiting for those interest rates to come down, how long do you want to wait as this continues to move up and to the right, as it has since 1991, even blasting through a 100-year great financial crisis, the biggest financial crisis of our time, which happens to be in the middle. These home prices continue to do nothing but move up and to the right. Every home buyer concerned about rates should be thinking about that chart. Again, all the charts available for you to grab and go inside of BAMX. The right now, 12-month house price changes per region. Again, U.S. down from the 6.2 prior year to 4.4 here. Pacific region is up. Mountain region is up. West, North, Central down. West, South, Central down. East, North, Central down. East, South, Central up. New England down from where they were last year. Middle Atlantic down, as well as South Atlantic down. So even with like New England, for example, having some of the biggest gains in opposed to the rest of the country, down from year prior, according to the FHFA analysis and report. Again, that was just released here. If you look at FHFA's top 100 metro area rankings, you see in Miami still leading year over year at 10.8%. Hartford, Connecticut region coming in at number 2. These are 10% gains on home price appreciation. Okay. And the quarters for these two regions, Miami at 1.2 and then Hartford at 3.1% quarter over quarter. It's a monster quarter. El Paso, Texas had a monster quarter at 3.7%, coming at 8.7 for the year over year. Top five would be Miami, Hartford, New York, Jersey City areas, White Plains included in that region. So you got Manhattan, Jersey City, White Plains, Camden, New Jersey coming in at 4, Anaheim, Irvine area coming in at 5. To go through the top 10, El Paso, Wichita, Kansas, Nassau County at 8, Dayton, Ohio at 9, Newark, New Jersey coming in at number 10. We go all the way now to the bottom. You start to see some red. Okay. According to this report here from FHFA, year over year, areas that are in the red, metro areas would include Denver, San Francisco, Oakland, New Orleans, Austin, Cape Coral, Florida, Jacksonville, Florida, San Antonio, and Northport, Sarasota, Florida at the bottom at 6.4%. Quarter over quarter, you saw Honolulu coming in at negative 6.8, Syracuse at negative 0.5%. Others to note quarter over quarter would be Allentown, Pennsylvania, negative 1.3, Fort Lauderdale, negative 1.1, Tulsa, Oklahoma, negative 2, Greensboro, negative 2.2. So Tampa on the list there at negative 1.6. So you're seeing some quarter over quarter movement towards red. Some of these year over year numbers are pretty much flat as it is. Another quarter like that would push like something like Tampa into the negatives for the year over year, as well as, Fort Worth gets another negative 0.3. They're going to be flat areas to watch as we move through the end of the year. We expect these numbers to move a little bit more red into the winter months until we get to that spring market. We'll see where the rate is at. Obviously, the projections are starting to cool off on the 30-year fixed, 4.304 here on the 10-year today. The 30-year yesterday came in at 6.93. So we did see improvement on the 30-year fixed yesterday, while we did not see much of an improvement from the CME forecast on what the Fed's going to do in December here, coming up in just about 3 weeks on the next Fed meeting and decision time for what they will do. Current target rate is 4.5 to 4.75. You see a 40% chance that they just stay there, according to CME Group, but still a 60% chance. That's where we've been about before I went on vacation. That's where we were. So that's basically where we're at still today on the CME Group. As more data comes in, I don't expect much movement in the markets here as we go through the rest of this week. Stock markets are open tomorrow. We'll be open tomorrow here on the hot sheet, and I'm looking forward to joining you back 9:30 on the east, 6:30 on the west. You know the deal in between. Really appreciate everybody who's been part of the hot sheet here for the last couple of, as we close out the second year in the hot sheet. Please subscribe to the channel if you're watching on YouTube at NowBam on YouTube, and would love for you to consider leaving the hot sheet a review over on Spotify and or Apple. All of the live streams get uploaded there for folks who want to do the replay on their audio. Later on in the day, a lot of people do not watch it live; they listen to it later. So, would love a review over on Apple or Spotify if you've gotten value out of the hot sheet each and every single day. Glad to be back, and again, be back with you again tomorrow. Looking forward to that. Thank you guys. Have a great Tuesday, great holiday week if I don't see you back on the live show tomorrow. Until next time, of course, toodaloo.